This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 78 was recorded on November 18th, 2019. I'm Eric Townsend. Alhambra Investments CIO Jeffrey Snider is back with us today. As usual, Jeff has prepared a terrific slide deck to accompany today's interview. We'll be making extensive references to the slides in that deck, so I strongly encourage you to download it and follow along as we discuss it. You can find the download link in the description of today's interview on our homepage at macrovoices.com. Jeff, it's great to have you back. Now, at the end of Q3, everybody was kind of in a panic. We had everybody talking about recession. Zero Hedge was ablaze with predictions that Q4 of 19 was going to be just like Q4 of 18, and history was going to repeat. There was going to be a huge risk-off event, and the sky was falling. It seems that now we're into the second half of Q4. Not only did that not happen, but we're grinding to new all-time highs this week. It seems like now the narrative has shifted to, okay, that was just a classic case of a growth scare. Actually, everything is fine. The worst is behind us. There's nothing to fear. It seems like an ideal time, Jeff, to get you back and ask you how you look at this question from your perspective. Are you seeing this as just a growth scare, nothing to fear, or possibly is there more to it than that?
Well, Eric, the current conditions do seem to fit the textbook profile of a growth scare, and that does seem to be true. The bond market, of course, was leading the charge as far as recession warnings were concerned. If we start out on slide 3, for a little over 2 months now, it has backed off of those, or at least it has appeared to back off of those recession warnings. And during that time, central banks around the world, they've woken up finally, and they've stepped up and started doing all sorts of monetary programs. They've become very dovish. And what I'll be highlighting here is that we've seen this movie before. We've seen it happen time and time again. We get an outbreak of pessimism, a central bank reaction that somewhat relieves that pessimism, and then a realization in the markets that rate cuts or whatever form of or what other kind of policy shift that was undertaken doesn't actually solve the problem. And the best place to start looking at that is where I always start, and that's with the yield curves themselves and the money curves too. From late November last year all the way through to the end of August, the Treasury yield curve, as you know, as our listeners know, it distorted, it inverted, and it dropped almost without interruption, which was truly remarkable. It was an unmistakable singular trend. 9 months of the market saying, hey, trying to get everybody's attention, something is going wrong here. Then at the end of August and the beginning of September, if you go to slide 4, it all kind of calmed down a bit. Even during the repo mess in mid-September, all the curves were relatively benign during that time. So if that trend up until September had been a warning about the possibility of a recession, then the break in it might seem to point in a different direction. At least that's what many people are now saying.
Jeff, I want to go deeper on this subject of yield curves and what they might mean, and I want to tie it in with something Charlie McElligott from Nomura has told us, where he said, look, everybody gets freaked out about yield curve inversions because it's so well known as a recession signal. What people don't realize is it's really what, as Charlie put it, you have to fear the steepener. And he says, look, after a yield curve inversion, usually you get that yield curve coming out of inversion before the recession really happens. And it's the steepener before the recession, not the yield curve, that's your final signal. That seems to be kind of reminiscent of what we're talking about here. But I want to get, that's Charlie's way of thinking about it. And listeners, if you're interested in that, just put Fear the Steepener in the search box at macrovoices.com. You can find a couple of interviews with Charlie on that subject. But let's go back to your perspective on this, Jeff. Clearly, something is changing here because we were, down into an inverted case. Now we're back pretty much almost out of inversion. So something changed. Is everything better?
Yeah, I think Charlie's right. And we have to ask ourselves what exactly it is that has changed recently. Remember, the curve is often two very different parts approaching the same things from different perspectives. So the shape of the curve can be twisted and distorted by what's going on at either end. And historically speaking, when you encounter a recessionary period, which I think was Charlie's point, the curve actually behaves this way. And this is typical. Going back to 2008, for example, if we go to slide 5, between the initial inversion in 2006 and 2007 and Bear Stearns, when Bear Stearns kind of almost failed or was rescued by the Federal Reserve in March 2008, the yield curve steepened out quite a lot, even as things continued to go wrong and get worse. And I want to be clear here. I'm not going back to 2008 to suggest that something like that is repeating, simply because that's the last time there was a rate cut cycle going on. And that's what's really changed so far in 2019. As far as the front end of the curve is concerned, again, like between September 2007 and March 2008, the Fed was pushed into doing quite a lot of rate cutting. It is the cutting which steepens the curve, which steepened the curve back then too, as a more desperate FOMC tries desperately to play catch up after completely dismissing or downplaying the growing economic and financial disarray. This is generally what happens close to as well as at the beginnings of a recessionary period, not just 2008, but you can go back to 2001 too. You have a panicky central bank that finally wakes up and begins to act. And that's where we are now, just as where we were after Bear Stearns. It's how does the market react to those central banks' late reactions?
Jeff, you mentioned Bear Stearns, and I want to come back to that because I remember that event. And going into it, as nobody could believe that such an esteemed bank as Bear Stearns was actually going to fail, everybody was freaking out and scared to death as to what it could mean. But even after that whole situation was handled, really, I was still kind of concerned, like, what the heck just happened here? But the market was widely put at ease. The mindset and what prevailed in terms of all the news coverage and so forth is, okay, look, the regulators have done a terrific job of completely, totally eliminating any kind of systemic risk. There's nothing to worry about as far as contagion risk. That's all fine. We lost one bank. It's a lousy story for the shareholders of Bear Stearns. Nobody else has anything to worry about. Of course, that didn't last, did it, Jeff? So is there a corollary here to maybe a situation that looks good but isn't going to last?
Yeah, I think you're right, Eric. Back then it was, okay, a lot of bad stuff happened. All of a sudden, the sleeping giant woke up, and Ben Bernanke took a long time, but he finally got his head in the game. They'll take care of it. So don't fight the Fed. And that kind of attitude is deeply ingrained in everything that has anything to do with finance in the markets. It's the myth of the maestro. Alan Greenspan is always there, even when the Fed does very little to live up to its own hype, as it did in early 2008. So as you can see on go to slide 6, the yield curve following Bear Stearns backed way off of the collapse that had been building with it up until then. It wasn't necessarily the market buying fully the idea that policymakers had figured it out. More like the market was taking a pause in its pessimism and letting things play out for a few more months. And this is actually, again, it's quite common in how the yield curve shape changes through these recessionary processes. It happens pretty much every time there's a recession. There's always a give and take and an ebb and flow to these things. So the market wasn't too enthused about Bear either, Eric, but it was willing to give the Fed a chance to prove itself. Okay, you finally woke up, you did a bunch of things. And it wasn't just rescuing Bear Stearns. There was something called the Primary Dealer Credit Facility. There's all sorts of a number of different programs the Fed instituted. The market was saying, okay, we'll take a step back and we're willing to see where things go from here.
And all of those programs they instituted led to just a huge set of what I would describe as increased complacency. Everybody breathed a huge sigh of relief and said, okay, nothing's really wrong. It's all going to be fine. And the yield curve started to recover. And I think that's where Charlie's talking about fear the steepener. It's when you're seeing the yield curve recover from a signal that it already gave you. And that signal was valid. And you still got to take it seriously. But people tend to see that reversion out of negative territory. It's back to a positive number. Everything's okay now. So reading the next few slides, I can see that central bank officials took that market chance and went way overboard with it. The market gave them some slack, and as per usual, the central bankers took it as if they had achieved their goal of avoiding the recession altogether. And of course, we know where that headed. Let's fast forward to today, Jeff. Are the central bankers, again, too complacent in thinking that they've solved all the problems here?
Yeah, and I think the way you described it is exactly right, Eric, because it's not just people in the market or people in the financial media who breathed a huge sigh of relief in 2008. It was the central bankers themselves. Officials like Ben Bernanke, he talked about how the risk of a severe recession had passed. And all of these, you can read the quotes I'm showing you here on slides 7 and 8, showing that how, okay, the yield curve backed off, and they took it as a sign that, okay, we've done our job. It may be, we had to sacrifice Bear Stearns, but we got things right and things will be great moving forward. So there's a substantial misunderstanding, not just in the media or the marketplace, but I think especially among policymakers who really don't understand bonds and curves. Because, while the bond market paused after that first initial curve collapse in March 2008, what happened over the next few months was more than just a substantial influx of optimism. It may have been cautious optimism, but for the most part, everyone, the whole world just breathed this huge, as you said, we breathed this huge sigh of relief, thinking that, oh my God, it took them a while. Some bad things happened, but they had done it. Bear Stearns was going to be the absolute bottom, the worst of it, and the authorities had handled it with great skill and expert execution. And you could see that in our current situation where we had that repo problem in September, which wasn't really a big credit event problem, but central bankers came back in, they did overnight repo operations. Now they've responded with this not QE, and they're thinking the same way. Oh, we've seen the worst. The market's backed off a little bit. So therefore, recession scare over with, everything's great. When in fact, underneath it all, there was a lot of stuff still to be concerned about.
Well, Jeff, obviously we know today that that wasn't the case. So what was it that was going on in the bond market during that middle period, if you will, between the first part of the crisis up to Bear Stearns and then the much more damaging second part, which shows up by September of 2008? Because it sounds like from what you're saying, maybe there's an analog that the period we're in right now is similar to that breathing of the sigh of relief after Bear Stearns.
Yeah, and I don't think it was anything other than human nature. We're conditioned in the modern world to believe a great many things, including that nothing big or really bad happens frequently, if ever. So, it's especially not when we think about central bankers as being our best and their brightest economists sitting in the pilot seat of any central bank, which has, of course, the powerful printing press at its side. So, it usually starts out, and this is a repeating pattern that we see throughout, especially the recent history. It usually starts in what is this first act or the first part of the crisis, as you go to slide 9. There's a series of improbable or odd financial or market events and signals, all of which get more and more brazen and harder to just ignore as time passes. And, most people, they may not know exactly what it is, but even the layperson can tell that something isn't going right. Something is going on out there. In the bond market, that usually works out as falling yields and distorting yield curves that are against all mainstream expectations.
And during this initial phase, that's when central bankers are in the business of reassurance. They keep saying, nothing to see here. All systemic risks have been contained. There's never been a nationwide housing crisis before. All these kind of statements.
Yeah, and that only adds to the sense of general anxiety. Everybody else can see it. They can see something's going on here. So why can't the so-called best and brightest see it too? It leads to this disconnect between, okay, there's perception out there of something. We don't know what it is. And central bankers are always constantly saying, well, there's nothing to see here. Even if it's as simple as the yield curve inversion. Everybody knows that, even if they don't know exactly what or why, everybody knows when the yield curve inverts, something's not right. And that's usually what ends up happening. Go to slide 10. Authorities finally come around and they finally begin to act. And they really, because they have no other choice. These market irregularities pile up and these market signals pile up such that central bankers, they can't keep denying it and they can't keep silent any longer. And that's what starts this intermission or middle period, as you put it, Eric. The market builds up its pessimism in the first act. And then when central bankers finally move, there's a little bit of release from that pessimism. It's not a shift to optimism, which is kind of what the sense you get in the stock market or in the financial media, but it's a little step back from thinking that it's only the worst case possible scenario. As I said before, the market grows a little more patient to wait and see how everything plays out, even though while it's still maintaining an overall, more pessimistic outlook. But to some people, especially central bankers, especially back in 2008 and as well as these other periods we're going to look at, this little reduction in pessimism looks to them like the market is agreeing with them that their policies are being effective. And that's really never the case.
Okay, but that is usually when the bottom falls out, like it did in 2008.
Yeah, these changes in monetary policy, they don't actually work. If you go to slide 11, for example, the market cuts them a little slack to see if, okay, these central bankers are being a little creative. Maybe they'll, if nothing more than random good luck, they'll finally hit something that does work. But the market knows pretty well that given enough time, what will show up will be that these policies are quite ineffective. And if we go back to March 2008, as I said before, the Fed was creative in a lot of different ways. And not only did it rescue Bear Stearns by giving JP Morgan considerable support to keep the firm going, the Fed also increased its TAF auctions. It increased the dollar swaps. They did the primary dealer credit facilities, all sorts of these other acronym types of programs. So, in 2008, as in late 2019, there was quite a lot for the market to digest, thinking, okay, there's stuff going on both sides. Things appear to be getting worse, but there's also the chance that maybe some of these programs might end up being effective. But eventually, over time, more and more back then, the market saw it as, yeah, this is ineffective. The first act of the crisis has raised the possibility of negative consequences. This intermission in between was the market thinking if there was any way, there was any real way to avoid them. And then the deeper second act was those consequences really finally showing up all across the global economy.
And that wasn't just 2008, right? I mean, I remember from your other appearances here on Macro Voices and from the Eurodollar University series that we did. By the way, folks, you can find that at macrovoices.com/edu for Eurodollar University. You described then that these global dollar shortages have behaved like repeating cycles, big waves on the ocean. So I assume that you're going to tell us that there was also a first act, an intermission, and a second act in each of those other crises too.
Yeah, and it happens consistently each and every time, and it follows that same general layout. You go through them, on slides 12 through 17. You can look at the subsequent ones on those slides. It's the same every time. The initial phase is the market getting everyone's attention to say, hey, something's wrong. The boom scenario or the recovery scenario that you've been hearing about, that's not happening. It's not going right. And then for simplicity's sake here, I'm just using the 10-year U.S. Treasury yield to demonstrate the process and how yields fall when they're supposed to be rising. Then you get this intermission where interest rates back up a little bit. And then you get the second part of the dollar shortage or the crisis, whatever you want to call it, where yields fall much further. And you can see it across a whole spectrum of liquidity and financial indicators in the bond market, not just the 10-year U.S. Treasury yield, whether it be Eurodollar futures, swap spread, any of the number of things I usually point to in the bond market. They all act uniformly in that regard. So that, there's always this first act where the bond market tries to get everyone, including central bankers' attention, but it's never able because they're predisposed to say there's nothing to see here. Central bankers will always deny in that opening first phase. And that's always followed by this pullback, the backup in interest rates that we see now ever since early September. It's this intermission where the market gives central bankers and officials a chance once they finally wake up, which they always do. And then the central banks finally respond to that initial act, and the market lets it play out over several, if not a lot of months. In some of these cases, this middle period or intermission can take as many as 6-7 months to fully play out. But ultimately, it never works. And the second act always follows, which is when the real consequences finally materialize. In the subsequent dollar cycles of 2011-12 and 2014-16, for example, those consequences in the U.S. didn't mean full-scale recession, but it was close to one both times. And in terms of the global economy, both of those those previous cycles, they did lead to some pretty nasty recessions elsewhere. In 2012, there was one in Europe. In 2015 and 16, it really devastated all across emerging markets.
Okay, Jeff, so what you're implying is that right here, right now, in 2019, the bond market is merely repeating the same cycle or process that we've seen before. Late in 2018 and throughout most of 2019, up until August, that was what you call the opening act. The bond market trying to get everybody's attention to warn them that something isn't right. After denying that there was anything to be worried about over the last summer and into autumn, the officials finally got it together and began to respond. So now the market is once again letting it play out to see if this time is actually different.
Yeah, and that's where we are. We've gone through that first phase. If you look on slides 18 and 19, We saw the bond market say, hey, something's not right here. People don't know what it is. The curve even inverted and everybody got everybody's attention. And because it did, in large part because of that, central bankers had to do something. And then you had the repo thing happen in September. So there had to be a liquidity response or attempted liquidity response in that place too. So, I mean, it is possible that Jay Powell is right, if you go to slide 20, that the U.S. and global economy is actually quite strong underneath and that this will all be nothing more than a mid-cycle adjustment, as he called it. Now, I don't think that's likely, and I don't think the market think that's likely, but it's at least possible. We don't have a crystal ball. We can't foresee the future. All we can do is our best to interpret both these repeating cycles as well as these market signals and indications. Now, the backup in interest rates we've seen since September seems to me, and I think to the market, much more consistent with these previous periods that we've highlighted, the recent past and these repeating cycles, that we're just in the middle between the opening act, which was the initial downward move in interest rates, and what will probably come later after a couple of months of digesting these central bank responses. And if it is this latter case on slide 21, then we're closing in on that more important phase. It's always the second act, which is where we find out what it means when all of these negative factors start to combine and become consequences in the global economy, and whether that means, how much economic and possibly financial damage in what I think is this fourth dollar shortage. We're getting closer to that period where we'll find out what that actually means.
Now, Jeff, at risk of using that feared phrase of this time is different, it seems to me like there's just one aspect of this that maybe is a little different this time, which is that in these past cycles, when you go through the opening act, well, it scares everybody a lot, and you see the stock market down a lot. And yeah, you get into that point where you're describing us being at now, where officials are reassuring us that everything's fine. That allows the stock market to partially recover some of those losses as people are breathing a sigh of relief. It seems to me like what's different this time is, as you're saying, we're very much in this cycle where we just got a really, really, really bad signal of yield curve inversion. Things could be really, really bad. Now we're in this breathing a sigh of relief, but instead of just coming off of their lows, stocks are just grinding to new all-time highs this week. Is that because we've gotten so much complacency among investors that they're just convinced that central bankers are going to come to the rescue no matter what happens, nothing can go wrong, that they're overly complacent? Or is there something else about the structural nature of this dollar shortage that somehow is allowing stock prices to stay so elevated?
Well, I think it's exactly what you said. Stocks are infatuated with the idea that central bankers can ride to the rescue, number one. But number two is, I think, especially when you look at how stocks behave in smaller timescales, it seems to me that the stock investors are thinking that whatever's going on in the global economy, we know it's not good. It's a negative trend. But I think the perception is that it's trade wars, and that eventually what will happen is, the Trump administration will wake up before it's too late, and they'll get a trade deal signed with China, and everything will be fine. And that all of this negativity in the global economy is just a trade war phenomenon. And therefore, if we fix the trade war, we fix the global economy. And I think that's one of the reasons why stocks are behaving as they are, is this pervasive belief that if the trade wars broke it, an end of the trade deal will fix it. And I think that's a mistake, because to me, it's not the trade wars that broke it. It was this fourth dollar shortage. And that's why we're seeing the cycle play out almost exactly the same way it has before. And I think stocks are going to be in for a rude awakening, because even if there is a trade deal, it may not make as much difference as maybe people are betting on.
So presumably in that case, the sequencing would be something like we get the trade deal. There's probably an initial pop higher in stocks. Everybody is jumping for joy. That's got to be it. It's all off to the races from here. Then it turns out that the factors that were leading to that fourth dollar shortage didn't go away after all. So reality sets in after the fact by some delay period. Is that the right way to think about this?
Yeah, and I think that's probably a scenario of how things could happen, assuming there is a trade deal. I mean, that's a geopolitical factor that's hard to predict, and there's always ebbs and flows in it. But even if assuming that a trade deal does get done, I think that's how people will react. People will react very positively to it, because, again, it's a very pervasive belief that trade wars are the problem. And if we have a trade deal, that fixes the problem. And then after however much time afterwards, it's going to be, oh, wait a minute, trade deals didn't fix the problem. Now what? What really is the problem? By then, it might be too late.
And at that point, just thinking about this time sequencing, we're probably looking at presidential election time and all kinds of complicating factors. So we'll have to get you back on as we get closer to that for another update. So I want to thank you for this interview, Jeff. Listeners, stay tuned this week. We've got more terrific content coming your way. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.